Good evening, ladies and gentlemen. This is Barry Norman on behalf of CMS Trader and Investing.com, and welcome to our webinar on day trading. Now, tonight's class is sponsored by CMS Trader. That's Capital Markets Traders, one of the world's leading providers of Forex and CFD trading. Now, because CMS is a regulated provider, I have to read you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, if you want during this class, you can go to www.cmstrader.com and click on the buy or sell button, open a demo account almost instantaneously. You just have to put in a username and a password, and you'll be able to follow along with what we're talking about tonight about day trading and see how to do it right on the CMS Trader platform. Now, if you go to www.cmstrader.com and you're unable to access it, it's because CMS is not regulated in your home country, and CMS only provides services where they are approved and regulated by the government. Now, there's many reasons to deal with CMS. You'll get unlimited access to their platforms. You get free daily signals. You get daily market updates and technical analysis, and you will get trading accounts with exceptional conditions, and you'll have instant access to your personal account manager. When you trade with CMS, you get a wide range of instruments for CFD, Forex, stocks, commodities, and indices. You can also use their watch, copy, and profit social media experience, where there's no experience necessary. You just follow along their best and most successful traders on the platform, and you can instantly copy their trades by using a simple one-click method. Or you can learn how to become an independent trader with CMS Trader. They'll give you one-on-one sessions with financial experts. They'll give you a whole library of ebooks and video tutorials for both beginners, experienced, and professionals to make sure that you can become an independent trader. Now, tonight's class on day trading is being recorded, and you can access this class in about 24 hours after tonight's session is over by going to www.investing.com, where you register for tonight's class, and look under the Education or Webinar tab, and then look for Webinars on Demand. And like I said, in about 24 hours, you'll be able to see a copy of this class. So let's talk about day trading. Now, remember, day traders are different than investors in that a day trader holds their securities for only one day. And that's the biggest rule. You're in and out of the market in one day. So you're not looking for positions that are going to go up over a period of time. You're looking for inequalities in the market or where a market has momentum to carry it in a direction, because a market that doesn't have momentum doesn't help you much for day trading. Volatility and momentum, whether it's going up or down, is one of the key elements in day trading. A day trader closes out their positions at the end of every day, and that starts all over the next day. By contrast, swing traders hold securities for days and sometimes even months, whereas investors sometimes hold them on for years. The short-term nature of day trading reduces some risk because there's no chance of something happening overnight to cause big losses because you're not in the market overnight. Meanwhile, many investors have gone to bed thinking their position is in a great shape, only to wake up in the morning to find out the company announced terrible earnings, filed Chapter 11, or the CEO is being indicted on some type of fraud charges, and every bit of their money is gone, or all their profit or all their trading is gone against them. But there's a flip side. The day trader's choices of securities and positions has to work out in a day or it's gone. There's no tomorrow for any specific position. Meanwhile, the swing trader or the investor has the luxury of time. As it sometimes takes a while for a position to work out the way your research showed it should. In the long run, markets are efficient and prices reflect all information about a security. Unfortunately, it can take a few days for short runs for this efficiency to kick in. Now, remember, one of the most important rules to any market and to any trader and any style of trading is to have rules. It's to leave your emotions out and follow a trading plan. And if you want to call yourself a day trader, the first rule is you don't leave positions run. A day trader leaves the market with nothing on the table, regardless of whether it's a losing position or not, or a profitable position. When you shut down your computer, you have no open trades. So yes, you could be somebody who keeps trades open for a day or two and waits for them to move in your favor, but then you're no longer a day trader. So remember, when you take up day trading, the rules that may have helped you pick good stocks and find good mutual funds over the years will no longer apply. This is a different game with different rules. Now, day trading is a crazy business. And believe me, I was a day trader when the markets were a little bit quieter 40 years ago. It was a whole different world. Today, the markets are insane, and day trading is one crazy, stressful business. It's one of the reasons you have to have rules. Traders work in front of their computer screens, reacting to blips, each of which represents real dollars. They make quick decisions because their ability to make money depends on successfully executing a large number of trades that generate small profits. Now, that's another key to being a day trader and defining yourself as a day trader. It is lots of positions open and closed in a day's period that make you small amounts of money. A day trader is not looking for something to ride the rally. They're not looking for huge profit. They're not looking like a normal trader like you and I, who sometimes closes a position in a day, sometimes closes in an hour, sometimes lets it run till tomorrow. Okay, we're looking to ride that wave. We're looking to make the most profit on a profitable trade. Day trader doesn't. He wants to make the most trades possible that have profit, but he's looking to make small profits on quick market momentum or quick market volatility. A day trader is not looking to be attached to anything. Now, because they close out their positions in the stocks, options, and future contracts they own by the end of the day, some of the risks are limited. Each day is a new day, and nothing can happen overnight to disturb an existing profit position. Because those limits on risk can limit profits. After all, a lot can happen in a year, increasing the likelihood that your trade ideas will work out. But in a day, I've made a lot of trades where I've done all the analytics. I've watched price action, and I've made a trade. And fortunately, the market is not volatile that day. And the trade doesn't particularly move in my favor, but doesn't move against it. So I'm not stopped out. So I can let it ride overnight, and I can let it ride until it's moved in my favor. Okay? As long as I have been stopped out, I can let a trade keep riding and riding. I can have, sliding stop losses or trailing stop losses and keep moving up in the profit. I have that luxury when I'm not defined as a day trader. But a day trader, everything has to work out for you before you close down your computer. So you have to be patient and work fast. Some days there is nothing good to buy. And that's really a difficult scenario for a day trader who's looking to open up lots of positions. But some days the markets are just ranging. Whereas a regular trader, well, you find something to buy today, you don't find something to buy today. You find something to sell today, you don't. Okay. So the question is, do you have the fortitude to face the market every morning? Now, I understand a lot of us out there aren't everyday traders. Okay. You know, we have jobs. We have other work to do. We have families. So you're not a full-time trader. And you can day trade part-time. But remember, each trading day is different. Traders won't find 2 days in the market that are exactly alike. Yet, even though each day is exactly like another, there are still patterns that tend to occur over and over, hidden with the seemingly randomness of price. Day trading was originally only available to financial companies because only they had the access to exchanges and market data. And that's what I started saying. When I started trading 40 years ago, we didn't have access to this information. I had to actually have a desk in a broker's office to be able to use his computer system, but there was no internet. And we were using, the feeds that he had, but we were sitting in a broker's office watching the ticker tapes come through and the feed outs that come through, because the only people that had this data were financial companies. But with recent technologies such as the internet, individual traders have access to the same exchanges and market data and can make the same trades at very low cost, because you're getting instant responses. And your platform now is faster and more responsive than what I had when I was sitting back in the broker's office years ago. So today, anybody can be a day trader. Now, there are several different styles of day trading, suited to different day trader personalities. The styles range from short-term trading, such as scalping, where positions are only held a few seconds or a few minutes, to long-term swing and position trading, where a position may be held throughout the trading day. Most day trading systems have a lot of flexibility and can have open positions for anywhere from a few minutes to a few hours, depending on how the trade is doing. Some days traders will try multiple styles, but most traders will choose a single style and only take up that type of trade. Now, the reason being is you need very specific tools. Whether you're using AIs, whether you're using apps, whether you're using whatever tools you're using, whatever strategies you're using, in order to day trade, you have to be able to respond very, very quickly. So you have scanners out there that are scanning, because you can't watch all the assets. If you're trading Forex, you can't trade. If you're trading stock market, you're trading future, whichever you're trading, you can't scan the markets fast enough looking for things. So you're using scanners or robots who are scanning and looking for a particular thing that you've set up that you want to see in the markets. Okay. And all this is doing, it's not making you trade for you, it's triggering you to go look at that asset. So you have to have these set up. So to set them up for multiple styles and understand the difference gets very, very difficult. So most day traders pick one style and follow that that's particularly good for them. Day trading also has different types of trades, such as trend trades, counter trend trades, ranging trades. Trend traders are trades in the direction of the current price trend, buying if the price is moving up. And counter trends are trades against the direction of the current movement. Because what we're looking for is we want an asset that's moving up, but an asset doesn't move up. It pushes up, eases down, pushes up, eases down, pushes up, eases down. All that a day trader is looking to do is to find an asset that is moving up or moving down, find when it eases down to its retracement level, and buy quickly to sell it in this one wave of that movement and be out of the markets here. Okay. Where A longer term or a daytime swinging trader, somebody who's trading it, say opening a trade in the morning and letting it run for the day, okay, is looking to buy at the same position, but he's looking to sell it at a farther point down the line. But you have to decide what style fits you. Or you have the counter trend trader. What he's looking for is he's looking for when the asset pushes up and hits a higher high or a new high, it starts easing down, and he wants to sell against the trend. So he'll sell into this way, ride this way, and come out at this level here. So he's going to try to buy here to sell down here. So he's trading against the trend or counter trending. Then there's people who are looking for range trades. That's when the asset is moving sideways in congestion, and they're looking for it to break out of that congestion either up or down. Each one of these are different styles, and you can't, because you're trading so many trades so quickly, you can't trade all of them because you can't track them all. So ranging trades are trades that go back and forth between two prices and are used when the market is moving sideways. Now, it's one of my favorite types of trading, and not for necessarily day trading. It's when you can find congestion and you can isolate a support level and a resistance level and trade that asset every time it bounces off support and comes down to hits resistance and moves back down to support, moves back up. It's another style. Most day traders will choose a single type of trade, but some traders will take different types and choose which one to trade depending on the current condition of the market and also the current set of assets they're looking at. Some days, if you're trading, say you're just a cryptocurrency trader, some days the cryptocurrencies, all of them, aren't making much movement. They're sideways ranging. So there may not be any trades available in that market to you at that moment. Stock market's another one. Stock market sometimes is just completely boring and sideways. So in addition to style and type of day trading, there are some variances between day traders. Some day traders like to make many trades throughout the trading day, while others prefer to wait for what they consider the best conditions for their trade, and perhaps only make one trade per day. However, many trades are made, and the trading process that is used and the desired goal for making profits are the same. So what is the biggest rule of day traders? They have no positions open when they stop trading. But very few day traders look for the optimal trade of one trade, because it's easier to find markets that have volatility and make a couple quick pips and be out of the market and make a lot of those trades than sitting back and researching and finding that perfect trade and letting it run, because you have to have enough trades, because you're not going to make profit on all trades. In fact, you're going to have losses on most of your trades. You want to have, if you open up 5 trades during the day and each one loses $100, you need to have enough of those winning trades to get to that 10th trade that's going to pay you back $1,000. So you lost $900, you made $1,000 on the 10th trade, and you ended up with a net of $100. Well, for a whole day's worth of work, that's not so much. But if you executed 30 trades during the day and you ended up with $300, you're doing a little bit better. So, and because your rules require you to be out of the market in the day, making one single trade and looking for the best trading situation, because that situation may not present itself until late in the trading day, and you have to close your position before it ever moves into enough profit to make it worthwhile. Now, there are many different financial instruments and markets that can be day traded, and they are offered by various exchanges throughout the world. The main type of day trading markets are futures, options, currencies, and stock markets. Now, a day trader, a smart day trader, because there's no rule or law, but a smart and the successful day trader picks only one market. Now, let's go back and talk about this. 10 years ago, 15 years ago, everybody was pushing the day trading. And you saw all these ads of these secretaries and businessmen laying on the beach with their laptops, making trades and getting rich, and trading for a couple hours a day and making ungodly amounts of money. Okay, let's forget that. That's all bull. Day trading is a hard job that doesn't allow time for relaxing and is extremely stressful and requires lots of work. Whether you're doing it part-time or full-time, it's not something that's going to make you rich overnight to lay on the beach and make tons of money and drive your Rolls Royce. Not going to happen. Now, you can be very successful. Most of my friends that day trade have been doing it for a very long time and make a very nice living at it. But it's a job, whether it's a part-time job or a full-time job. Okay, none of them are laying on the beach. They're all working as hard as I do every day. So within these types, there are groups of markets based on stock exchanges such as the Dow or the DAX, currency exchanges such as the euro and the dollar exchange rate, commodities such as gold or oil. Day traders can have access to all of the exchanges and their markets via direct access brokers. Now, if you're trading on CMS Trader, you have direct access to it all via CFDs, which makes it a lot easier than any other type trading, Forex or CFDs, because you actually aren't taking ownership, and your overhead costs of making the trade are just simply the spread. Because you've also got to factor in to your day trading is what is your cost to the trade, because you're making lots of little trades throughout the day. You have to also cover the spread for every one of those trades. But fortunately today, you're not paying a minimum commission. So first, let's be clear about what day trading isn't. It's not investing, which is the process of buying a stake in an asset that will hopefully build a profit over a long term. How long is subjective, but investors generally hold assets for years or even decades. And they're usually concerned with the business they invest in. They look for companies that can make solid profits, pay off debts in a timely manner, and have a strong pipeline of products to avoid litigation. In between the two extremes, investing for years and trading for seconds, exists other investment horizons and other types of trading. Swing trading refers to holding a stake in a stock or commodity for several days, or I call myself predominantly a swing trader. Sometimes I hold a position for a couple weeks, never ever more than that. Now, would I close an asset out in a day? Yes. Oh, but only if it reaches my target point within that day. I'm less concerned with time and more concerned with the technical and the fundamentals of the asset moving as how I've faced it out. Then, because we also have position trading. Position trading refers to holding a stake in a stock or commodity for several weeks or months. They all carry a certain amount of risk, but day trading is probably the riskiest and the most controversial. When we look at the history of day trading, we'll learn where its infamous reputation came from, which we already touched on. That was all the big ads from the early 2000s when online trading just started becoming big. And we got all of this stuff out there about people getting rich overnight. Day trading is a relatively recent phenomenon, one made possible by several events and rulings throughout the past century or so. In theory, anyone could become a Formula One race car driver, but in reality, very few people possess the right skills or temperament for such a demanding sport. The same is true with day trading. Day traders must possess certain personality traits and have access to certain resources if they're to be successful. Now, one of the reasons I wasn't really a day trader, I traded my own account through a broker, but sitting on the floor, but I was an agricultural trader, and most times I didn't keep positions open that long. But I don't have the temperament for being a day trader. Just don't. I get stressed out when you're making too many trades too quickly, and my personality tends to be more into doing the technical analysis and slowly analyzing and finding the right circumstances in the right trade. whether it's going to close out in 1 day, 3 days, 2 days, 24, it doesn't make a difference to me. But this is my personality. Okay. So we have to respect who we are. Now, day traders must have an understanding of market fundamentals if they're going to succeed. Most have many years of experience investing and trading in various markets. They also research constantly using services provided through full service online brokerage accounts or information from publications like Wall Street Journal. They've researched all their sources. They know how to get their news the fastest. They know how to do technical analysis. They have the fastest charts. They get the fastest feeds. They have the fastest economic calendar. They get everything because they need that edge. They need that speed of information. They use robotic trading, not robotics to scan and search the markets. They use AIs. They use all types of other types of tools that the computer, that advanced computers today and online trading offers. Okay. But it takes money also to make money is a cliche that resonated with day traders. That's because they often borrow money called leverage to use in the markets. Now, when you're trading CFDs and Forex, leverage is built in, and it's one of the nicest things about trading with CFDs because the leverage is built in. So you're not really borrowing technically money, and you're not staying in the market overnight, so you don't have overnight charges. But you're using leverage. While this is risky, and remember, it is risky, for every bit of profit you're looking at, you have the equal amount of possible loss. Okay. And even though you're making lots of trades, to make that $100, you might have to have, $1,000 or $2,000 invested, but you don't have that kind of money. So you're using leverage as just taking up $86 or $95 from margin from your account and allowing you to trade a position that's large enough that you can make a couple $100 per trade, because that's all that you need to make. And in the Forex market, you don't need a market to move that much. If your position's large enough, all you need is a couple pip movement to make that profit. But it also has the risk of loss. So using a large amount of capital to make many small trades increases potential returns. Day trading is a business, and as such requires a business plan. And as I mentioned earlier, it requires rules, very specific rules, and a set of actions and reactions, from how many trades you'll make a day, to what days you're going to trade, to what times you're going to trade. And even if you're a part-time trader and you can, the wife and kids are out, soccer games and everything else, so you can trade after work Tuesday, Thursday, and Friday. Well, that gives you the time. But your rules should say, I'm only going to trade Tuesdays and Thursdays. Friday, I'm going to do the analysis, and I will go every Friday and analyze everything I did all week and look at where I've been successful. Everything isn't about trading. So you have to have this plan. And most plans address short and long-term goals, target markets, trading hours and days, business setup needs, capital reinvestment, tax considerations, reporting and metrics, as well as risk management and money management. Your plan should include how much you're willing to risk per position and how many of those positions would you have open at any one time in the market. Day traders separate themselves from their emotions and never act impulsively. They always work with risk capital, which is money they can afford to lose. They use stop and limit orders to reduce losses, and they always close out at the end of the day. Day trading functions through electronic communication networks. A trader accesses these networks using a computer and a high-speed connection. A typical setup might include 2 monitors working off one PC, a second clone computer to serve as a backup, cable broadband with DSL backup, and a wireless router for a laptop. Many day traders use analytics software to search for trades and receive information and execute trades and manage accounts. So you have to be, today you have to have and understand technology. Okay. When I used to day trade, you did. I would sit in the broker's office and I would actually tell the broker in the trading room what I want to execute. I didn't have to have any computer skills or understand technology. I just had to understand the markets. Today, it's all about these few pips and all about feeds and speeds and everything else. And you have to understand what technology is out there, how to use it best, and why one charting service is better than another, and how the feeds accept it, and how the update time, all of this is important. So people who attempt to trade without these attributes or resources are very likely to fail. And many do. Those that succeed encounter a severe learning curve. Once they gain experience, traders often take up day trading professionally, either as part of a larger institution or as a lone ranger. Institutional day traders work shoulder to shoulder with other traders in large computer-laden trading rooms. Individual traders work from home or their own offices. And the fact is, you have to have the same technology that a bank has. You have to have the same information that a hedge fund has. So either way, it's a full-time occupation. Part-time day trading, though, is possible, but difficult. Those who adopt a part-time approach still treat their trading as a business. They set up a schedule and follow it rigorously. This discipline distinguishes them from hobbyists and those who experiment with day trading as a form of gambling. Okay, so day trading is a skill. It is a business, and it requires you to enter the markets as such. And it requires just as much time in learning, education, analysis, and self-evaluation as it does trading. So in fact, unfortunately, many compulsive gamblers have lost significant sums of money attempting to day trade because they're just looking for the high and the rush. And if all you're looking for is the high and the rush, don't be a day trader. Be just a crazy online guy out there who's getting a high and rush and going to know he's going to eventually lose his money. So Gamblers Anonymous has even opened up a day trading division. Day trading for beginners usually starts with research. They look out for different ways to improve their trading and dedicate a vast amount of time to search for the Holy Grail. The Holy Grail is what traders call a perfect indicator or a trading system that provides 100% setups, with a 100% success rate. Even some experienced traders do it from time to time. Unfortunately, perfect systems don't exist, and the only Holy Grail is proper money management. If you're going to be successful, the only thing you can be sure about and that you should be concerned with is risk management, money management, and price action. Because if you can find a way to reduce your losses, your profits will come. Even statistically, out of every 10 trades, you might have 2 successful trades and 8 losers. But again, as long as you can limit your loss in those 8 losers, those 2 successful trades should balance it out. Now, develop a strict trading plan and follow it strictly to manage your risk properly. Day trading Forex is riskier than long-term trading, mostly because of the higher pace and frequency of trades. Day traders experience more pressure and have to be able to make quick decisions and accept full responsibility for the results. A trading plan is an absolute must for a day trader. Keeping an eye out for averaging down. Simply put, averaging down is keeping a losing trade open for too long. To avoid it, cut losing trades in accordance with pre-planned exit strategies. Day traders don't want to let the trade run till it runs into profit, or they don't want to guarantee themselves and say, it's going to turn around. If it's not doing exactly what you said it was going to do, day trader closes out his position because he's going to open up 8 more, 10 more during that day anyway. So remember, averaging down when day trading eats up not only your profits, but also your trading time. And remember, a day trader is all about minimizing his risk and his exposure. So every trade wants to have a well-calculated stop loss. within very strict risk-reward ratios. Now, there are two kinds of stop losses that a trader must consider using. A physical stop loss order placed at a price level in accordance with the risk tolerance, which you should know from your trading plan. Approximately 1 to 2% is a good level. Basically, this is the most you can afford to lose in one trade. The other kind is a mental stop loss, and this one is enforced by the trader when they're getting the feeling that something is going wrong. And this one's for the suckers, because the markets can move quickly, quicker than you can, and you have, if you're not glued to your computer and you're just distracted on another screen looking at a chart, before you know it, you could be way down on losses. Mario Draghi comes out and says something, Donald Trump does something crazy, before you know it, that asset could have reversed and killed you or moved, just skyrocketed up. Okay. Every trade should have a physical stop loss place. Yes, you can leave the markets when you have a gut feeling that something isn't going right. We said that earlier. Don't chase them. If the market isn't doing exactly what you thought it was going to do, just close the trade. Have you ever entered a trade and watched the market make an unexpected turn and then suddenly realized that the trade is no good and it's time to cash out? That's a mental stop loss. The trick is not confusing it with just panic. That's why both physical and mental stop losses need to be thought thoroughly before entering a trade and not after. Retail day traders, specifically those who manage their own rather than somebody else's money, have another rule to their stop losses that they must comply to. They set a maximum loss per day that they can withstand financially and mentally. This is the point. If that point is ever reached, they remove themselves from the market altogether for that day. They know that no good comes from emotional trading. Inexperienced traders, in contrast, don't know when to get out. Some days you're just having a bad day. Some days the market's just moving away against you. Some days, no, you don't have, everything takes a grain of luck. And sometimes the luck gods turned against you that day. Go close down, go do something else. Exceptions to these rules are possible, but must be managed with specific care, and the results must be accepted with full responsibility. Good results must not serve to reinforce regular exceptions. Bad results should be considered as a good reminder as to why these rules exist. The trend might be able to sustain itself longer than you can stay liquid. Let's consider volatility spikes mixed in with drops in liquidity. When a news release are due, traders should refrain from trading altogether. Day traders do not want to trade around news releases. It creates too much volatility. They would like to trade as soon as that release comes out, because remember, a day trader just looking for that volatility. He just wants that short little term trade. He doesn't care if he's in the market for just 2 minutes or 4 minutes. Okay. So anything that creates market volatility and momentum is good, but do not trade around major releases, as the results could be disastrous. Wait for after the release. So the bottom line is, even if you somehow manage to know what the news will be, there's no way to predict how the market is going to react in the first couple hours. Bullish news can cause a bearish market jerk and vice versa. Eventually, the markets will return to its trend, but until it does, the environment isn't safe enough to trade sometimes. So also keep in mind that a trader might not be able to protect his account with stop losses around news. And there is no liquidity on the markets. The orders won't close. It will continue sleeping until the first available counterparty is willing to trade. And that's why day traders also only trade in major assets. You want to trade in high movement markets that have high volume and liquidity, because you need to be able to get in and out of your markets. So basically, it is only that their price that you are willing to trade. However, the best day trading strategy is always to trade at your price. So the bottom line is, you can be a successful day trader if you're serious, want to put the work in, and are willing to give it a good go. And you want to do the analysis, the research, the technical stuff. It's not just about entering trades. If it's just about entering trades and getting the high from trading, go to Gamblers Anonymous. Go to their retail, their financial trade class groups, and get away from this market, because you're just going to throw good money after bad and you'll end up losing. But if you want to think of it as a supplemental income or a full-time income, and you're willing to do the work, if you think of it as a business, and we realize that running a business requires time and effort and dedication, then day trading could be just perfect for you. So on that note, I'll say goodnight to you. Thank you very much for joining us. Thank you for supporting cmstrader.com. And if you go to www.cmstrader.com, you'll have access to all of their education tools, and you can talk directly with their financial analysts and their experienced traders, and they'll help you along in your quest to become a day trader. So thank you very much. And again, go to www.cmstrader.com, open a demo account, and see if you can be successful at trying day trading. No real money, no credit cards required, and see what it's like for you. So thank you very much. Have a good night now, and we'll talk to you again real soon.